good morning, good afternoon, wherever you are in this fine country of ours. It's Graham here, Graham Allen, the Regional Wealth Leader for the eastern half of Canada at IDC, along with my colleague Alex Chan out west. We are delighted today to bring another session. Probably, I think it's the last session of the year we've got lined up, actually, as far as from the investment team. We have Andrew Gardiner with us today from beneva. Andrew's title is Senior Business Development person on the investment side, and I should draw attention to the word senior. That doesn't mean that Andrew's old. What it means, like myself as a senior person, I would say in the business, I would take away the word senior and put in experienced, because I think that's something in this time frame and what we've gone through over the last year. That's what you want on your side when you're having your client discussions. Clients do need a bit of hand holding and maybe a little bit more than they've been used to over, especially over the last so many years, given that returns have always seems to be positive. The world has been one big, large GIC return for a long time, it seems, but we've been reminded that volatility is in the marketplace, and that's, I think we need the experience to make sure people understand that, and also that you're equipped and you have the tools to make sure that you can communicate that to your clients appropriately as well. So last session, as I said, for the investment team for the year, we're going to focus on some pre-RSP stuff, an RSP toolkit for you as we wind up the year and we start afresh in 2023. So I'm delighted Andrew's going to bring his experience to this and lead us for approximately the next hour. And I know it's going to be a good one. So Andrew, over to you. Thanks again.
Thanks, Graham, and thanks everybody over at IDC for having us on this particular webinar today. I'm very, very excited. There's lots of different things that we're going to be covering off. For those of you who don't know me, again, Andrew Gardiner, I'm the Senior Regional Sales Manager for Southwestern Ontario. We do have people across, this is the Ontario contact list. If there are people out west, we do have a dedicated wholesale team in Alberta, Saskatchewan, Manitoba, and British Columbia. One of the things that we did do with the combination of La Capitale and SSQ a few years back was we have dedicated people for insurance and we have dedicated people on the investment side. So when I first started, I'm from the La Capitale side. I started about just over 5 years ago. It was just myself and Jennifer Santos that handled all of the La Capitale investment platform. So it's really, really great now that we have enough coverage and we're here to help. The best way that we're going to be able to help you is that if you reach out to us, let us know what the particular situation is for an individual client, what you're looking to accomplish. We have no shortage of products and solutions that we're going to be able to cobble together, put together this jigsaw puzzle and make sure that we're putting the client's best foot forward. I'm not going to spend too much time on it, but some of you may or may not be aware of beneva and what it is. So beneva is the combination of La Capitale and SSQ. A lot of the stuff has been in behind the scenes up until now, but it's now starting to go into the next phase. So if you are contracted with SSQ only or La Capitale only, in January, it's going to be merged under one consolidated contract with beneva. So you will have contracts for all the insurance stuff as well as all the investment stuff. Up to now, it has been running off kind of two separate platforms. The investment will all merge together, and eventually it'll all be on one statement, one client portal to get in to see all their whatever investments they hold, they'll be able to see. So very, very exciting stuff coming on our side. And there's a couple other points I'm going to stress as we go through. So the first thing I thought we'd do, given what's happened over the last while, given the fact that we're going to be heading in, we're going to be seeing clients over the holiday season and Christmas parties and things like that, I thought we'd just do a little bit of a market recap and just take a look at kind of where we are and ideas and ways to handle objections and perhaps ways that you could be framing investments when you're speaking to clients. So as most of you are probably aware, it has not been a banner year for equities, and it has not shown here, but it's been even worse on a relative basis for fixed income. So all of the major indices, with the exception of the UK index, the FTSE 100, are all negative. And some of these are down fairly substantially, like an S&P 500 up until last Friday was down almost 17.5% year to date. That's the 500 largest US listed stocks. So a very common indices that people look at. Dow Jones would be a little bit more blue chip type of positions, and it's down about half of that at about 7.8. But you can see NASDAQ, which was the darling, those growthy type biotechnology, internet technology companies, is down, close to 30%, right? So these are fairly stark numbers, and clients may be sitting here today going, well, geez, I don't know what's going to happen. And it's this common psychology. When markets go straight up, as Graham mentioned, it's almost like a guaranteed rate of return. And that's how people thought. When it rolls over and goes the other way, it's like it can never come back, right? So we need to hold clients' hands during this time period. In my opinion, we'll call it the 1% trailing commissions that you receive on most types of investments. You're easily worth it just for that alone. If you can keep clients off the ledge and have them not hit the sell button, because I can guarantee you that they're going to hit the sell button at the worst possible time. It's just the nature of herds. And we're all part of this herd, and we're all part of this psychology. And just having a steadying hand to make sure that clients aren't shooting themselves in the foot is easily worth the 1% trail that you're applying as a commission. Never mind all the other good things that you do in terms of holistic financial planning. That's all the insurance for all the bad things in life that can happen, critical illness, disability, life insurance, whatever makeup that makes up. And then we do need long-term savings buckets. And that's where the investment side comes in. So pat yourselves on the back. I don't get too many redemptions, certainly considering outflows on these major ETFs or indices. We're nowhere near what those would be, which suggests that the advisor community has done a really good job of keeping people in. And it's for good reason. We know that, and I'll say this a few times, markets take escalators up and elevators down. And again, that psychology comes into play where people feel that it's just that elevator doesn't stop, it just keeps going. So in an historical context, a lot of brokers like to use this slide with clients. We're down and calendar year's coming near to an end. And there is a chance that some of the broader indices do turn positive, but maybe not. And this is the case, 10 times in the last 42 times where we had these inter-year annual drops of 14% or more. The actual S&P 500 actually ended up positive on 32 out of 42 of them, right? And you can see that those little red dots are what the market's max drawdowns were in a calendar year, and the gray bars are what the indices ended up at the end of the calendar year. So even though you get these big moves inter-year, markets have rallied, and they've even rallied recently. Like you've seen a more stabilization in these markets. But to be fair, the moves were rather stark. Like we were looking at, up and down moves of 3.5% to 4% in something like a broad indices like the S&P 500. That's not common, right? Those moves aren't common. So with that, the way these things kind of work out is that the more volatility begets more volatility. You have people that have made substantial amounts of money in the last 6 weeks. So they start to sell and markets roll over. So there will be a lot of this volatility. There's a lot of balls in the air. We are not in the habit, and hopefully you as an advisor are not really promoting the timing of markets. I know some are, and I'm not necessarily knocking it too hard. It's a very difficult thing to do because you actually have to be right twice, right? You have to be right on the way out, so move to cash, and then you have to time it on the way back in to move it into the markets at the right time. And it's just statistically not likely that you're going to be right twice. Keep in mind, if you bat 600 as an investor, you are the greatest investor in human history. So that means you would be wrong 40% of the time. And that's if you're even, famous people like Warren Buffett and things like that don't have that kind of batting average, right? So we're just going to focus on time in the markets. We want to remind clients, this isn't, it feels weird. And this time is different. That's the worst word you'll ever hear in investment. This time is different. History repeats somewhat, rhymes probably more likely, but this is nothing new under the sun. We've seen corrections like this quite frequently. And you can see on the slide here, we have 5% or more drops happen about 3.5 times a year. So that's pretty common. Once every year, roughly, you get a 10% drop. Once every 2 years, 15% drop. And then once every 3 years, you get something that we just went through, which is a bear market of a 20% more drop. So once every 3 years is certainly not that rare. These things do happen. Again, we know that if we can keep clients invested, then we're going to be able to ride these kind of waves, make sure that we're mitigating risk across all the points where we can, right? So that timing, mitigating timing risk, mitigating asset allocation risk, mitigating style risk, mitigating, asset allocation, and also like concentration risk and things like that, right? So those are all things you can control. You do not control what markets do in and out. And we can also control somewhat client emotions, again, trying to keep clients off that ledge. So this is from our friends at AGF. I'm happy to send this. They'll be updating it some point in the spring, but there's a lot of really great charts in here, a lot of good stuff that you can use with your end clients. This just shows $10,000 in the TSX, so the Toronto Exchange, 20 years going up to the end of last year, was 8% a day. 8% a day, that'd be nice. No, 8% annual compounding, your $10,000 grew to $47,000 and change. If you miss the top 10 trading days, then you could see your returns are basically cut down in half. Top 20 days, further down, and then right around the top 30 days, you're at break even. And this is why a lot of investors do not make money in markets. And you'll hear that lament, oh, I've never really made any money in the markets. Well, chances are it's because you were buying and selling at the worst time. You were caught up in that herd mentality and you were following it along. And the reality is that if you put your money into rock solid, professionally managed portfolios and added to it along the way, market timing risk, run those bi-weekly PADs into your RSPs and TFSAs or your non-registered accounts, you are going to be way better off than trying to maneuver in and out. A little bit further back, if you go back to 1929 and you held the S&P 500, again, 500 largest US companies, and you just let it sit there, you would have had a return of close to 22,000%. If you missed the 10 best trading days per decade, you're down to 58. I can't say with any certainty, but I'm pretty sure, statistically speaking, we've had some of those trading days over the past couple of months, since probably August 1st or so. There's been some very large moves to the upside, and obviously there's been some to the downside as well. So you just can't miss those trading days. And the only way to get around that is to kind of make sure that you stay invested. And again, if you can, add to the investments across the whole time horizon and try to mitigate that timing risk. $250 in 1956, and that S&P TSX would have grown to $80,000. So we got a lot of people, oh, real estate. Now I know real estate's it's been a great investment for 15 years, and it's certainly maybe lost a little luster over the past 6 to 8 months. But even if you took it, cherry pick these dates really to the end of last year where real estate hadn't had faltered yet, if you put $250 in Toronto real estate in 1956, it's not going to be worth $80,000 today. So again, the real problem with markets, it's not that they don't go up over time. The real problem with markets is that clients are shooting themselves in the foot by moving in and out. And these bull and bear markets are going to come, right? You saw the stats, they're actually fairly common. And when those the bear markets come, they tend to be very violent and short. And they, again, that's an elevator. And then you can see the escalators kind of come and take it out. In terms of time, you're looking at about a bull market lasting 42 months, we'll call it, average gain of 100%, which is basically doubling your money. And then you have a bear market comes along that lasts about 8.2 months and drops you 25%. There's no getting around the cyclicality of markets. If you're going to take market risk, only thing we can do is try to mitigate it as best we can. And if you have any questions regarding how we would do that or how we could do it together, then certainly just reach out and let me know. I received this from our friends over at Dynamic a week or so ago, and it's from David Fingold. David is a long tenured manager at Dynamic Funds. He has a couple of standalone mandates within the Beneva or La Capitale investment account platform. We have the Global Equity Discovery Fund, as well as David's Dynamic American Fund. And those ones there may not have done that great over the past, since the down markets here, but David has an unbelievable track record that goes back 25 or plus years. In any event, I'm just going to read this for you. I'll send out the full thing, but this is one paragraph that I took out of it, and I want you to think about it. And again, if you're having conversations, try to keep some of these kind of ideas in mind. It's time for active management. So as Graham mentioned, when you have a raging bull market, ETFs look really, really good because everything's going up. The ETF has to buy whatever the largest position is within that index. That's how it tracks the index, right? So bigger companies beget bigger companies, beget bigger valuations. It's an upward momentum push. Where it goes the other way, now they have to start selling, and the ETF selling causes prices to drop, which causes more, the percentages have to be lowered. They have to keep lowering it down, right? So this is going to be the time for very solid active management to work. Sideways markets. It's range bound, could be range bound. If you go back to similar setups in the past, like the 2000s or the 70s, you went into those decades, majority of equities were in bubbles or very high valuations. The bubbles get burst, and then it kind of trades up and down, right? According to David, he loves sideways markets because some companies are going up and some are coming down. And if you're really good at what you do, you try to find the ones that are going up and avoid the ones that are going down. In raging bull markets, everything's going up. So you kind of have to, if you really want to outperform indices, you start to have to get very aggressive and buy the most hyped, the most loved companies that are priced for perfection. And as soon as that perfection isn't met, the price gets cut in half. They usually do not have anything holding them up in terms of free cash flow. They tend to be very growthy companies. They don't pay a lot of dividends. There's not a lot of substance underneath it. And I always think of it, if you find companies with substance, it's like taking a ball and trying to hold it underwater. You can only push it down so far, or else, it gets pushed back up. And that's what free cash flow and dividends and value type positions do. There's a limit to how much those companies can go down just because they're underpinned by solid fundamentals, right? So that's kind of what he's getting at today. And he's talking about the technology drive got to 30% of the S&P 500. Every time that's happened, where a certain sector has reached such a high percentage of a broad indices like the S&P 500, it underperforms for the next 10 years. So what happened in technology back in the dot-com bubble of 2000, it happened in energy in 1980, it just kind of stays sideways. There was a very long time, a rock solid company in the past, like Microsoft, traded basically within a range, 24 to 36 bucks or something like that, right? For a very, very long time. Obviously, if you had loaded up on that company over that decade, you've done really, really well. And a lot of funds actually did. So they call it the curse of 30. If technology is going to work for the next decade, then it'd be something that's never happened before. It doesn't mean it won't happen. It just means it's never happened before. So we have to kind of look at, we're part of this psychology. And I can tell you that, people do tend to lean more towards those growthy companies. That's where the returns were, and that's what worked. It doesn't mean it's not going to work. It doesn't mean that we don't have managers that can navigate that particular sector. There will be winners within the technology space, and there'll be losers. So hopefully we're paying these people good money to manage these funds and to do their due diligence on the underlying companies. So hopefully they find them, and hopefully you have a place in your portfolio for these types of growthy type companies. Not telling you to avoid them, that's for sure, but just make sure they're not taking an overweight position, which might have been the case for some of your clients, especially prospects. If you get clients that are looking at right now going, I'm really getting hammered here, the people that I was working with, no one calls me back, and you take a look at their portfolio, it's quite possible that they had a pretty overweight position in growth or technology stocks. So let's just remind ourselves, this is November 30th, so the numbers are slightly different. And just so we line up with my next few slides in terms of times. So they're in the same ballpark as the original ones that I showed you from December 9th. But you can see, like I said, they're all down pretty good here. So has it worked? Has the active manager helped us out over these year-to-date kind of returns? And it has, and pretty much all of the beneva or soon and SSQ, I'll show you as well. The investment accounts have outperformed the relative indices over that time frame, and you can see what's really working were things that lagged, quite frankly, over the previous 5 years. So low volatility American equity fund, dividend fund, infrastructure, global dividend, equity income's another dividend fund. Low volatilities, those are going to be, again, those value type positions that do have, you tend to have very high internal rates, internal dividend yields. Canadian equities, tend to have high dividend yields as well. Low volatility, global equity. Canadian Balanced Fund from Dynamic, the equity portion, again, is going to have a high dividend position. And then you can see the rest of the list going down, right? So remember the S&P 500, let's go back and look at it. And so we remind ourselves. So the S&P 500 was down minus 14.39% to the end of November. Well, the low volatility American equity fund is a direct comparable to that indices. It's up 4%. So that's an 18% difference in what the index returned versus what the after fees, after your commission, low volatility American equity position did from TD. And that would be the same for a lot of these other ones, right? Like if we looked at the Canadian indices, the Canadian equities are beating it. So we do have clients hear about the index. That's what's reported on the radio, right? That's what they hear, but that doesn't necessarily mean that's what their fund has done. And it may be an opportunity if they say, gosh, the markets are down so hard. And if you look at it, it's like, well, you got a diversified portfolio and actually you're doing better. It may not be drastically better, but better nonetheless, right? So keep that in mind. Again, active management time to shine. This is just the list a little further extended. And you can see even, an American equity fund from Fiera, which is a large position for us, fantastic managers. It caught over 100% of the upside, and at minus, we'll call it 7%, it's half the downside of the S&P 500. And that's like, just because it's active management doesn't mean it's immune from drops, right? That maybe some clients kind of feel that way. You have to remind them that's not how it works. We are in the markets alongside of and we own some of the companies that make up those indices. The whole point of what we're trying to do is we're trying to achieve risk-adjusted returns where we're not taking on the risk of the indice, and we're trying to protect and create more of a smoother ride. And hopefully at the end of the day, it does produce better rates of return, which is the case on a lot of positions. You hear that too, that, active management can't beat indices. Again, tough to do in raging bull markets, but you have to go full cycle, right? Ups and downs, and see how everybody stacks out. And on an F-class version, which the advisor commissions have been stripped out, it turns out that the vast majority of active managers actually beat the indices. It gets down to that extra fee that is charged for commissions. But as I said, you're easily worth it, right? So people get lost in numbers sometimes about, fees and things like that. They're not assigning the right value to them. So long story short, in the short run, the market's a voting machine. It's a popularity contest. The things that are most popular get the most hype, get the most flow, drive the higher valuations. But in the long run, it is a weighing machine. So that means heft. What gives a company heft is its ability to create free cash flow, pay dividends, reinvest the dividends, have a good return on investment on internal metrics and things like that. And again, that's beyond my pay grade. That's why we pay people like David Fingold, who's been doing it a very long time and has a very good track record of managing assets to do it. Everything we kind of talked about so far are individual mandates, right? Those are individual funds. Don't forget, we do have set it and forget it profiles. This is the dynamic aggressive profile because it's 100% equity. So it gives you an idea of what goes on underneath the hood. And you can see that there's global equities, global dividends, some growth stuff in there. Anything with power in the front of it from dynamic is going to be, it'll be a growthy type position. And you can see here that even though it's one line on the statement, there's a lot of different things happening underneath the hood. They're putting together the jigsaw puzzle. They're going to create, in this case, 100% equity or pretty close to it portfolio. And they're going to make sure that all the different boxes are covered and that they have a nice rounded position. We also have AGF, right? So AGF has a similar kind of setup. They do it a little differently. They actually do deploy ETFs alongside. So passive management alongside active management to create this kind of aggressive bundle. So on the investment account side, as well as the segregated fund side, we've got lots of different choices. It's not a problem for us to build portfolios for conservative, moderate, balanced, growth, or aggressive within using profiles or using standalone mandates. I will point out the top one on here, the Beutel Goodman U.S. Equity Fund. Remember, the S&P 500 was down 14 and change. It's actually up 11 over the same time period. So that's a 25% difference in returns, which, to be fair, I don't think I've ever seen anything with that much difference over the broad indices that it actually covers. So good on Beutel Goodman. That fund is obviously dramatically outperforming, but you could see the rest, right? Canadian dividend, that GQG Partners on the SSQ platform is extremely good. Global infrastructure, global dividend, and so on and so forth. So again, lots to choose from. If we're talking SSQ segregated funds, you have 3 different contracts, the basic, enhanced, and optimal. So that's the 75, 75, 7500, 100, 100. I remind everybody on the call that optimal guarantee has a very unique crease in the contract. If you open the contract by the client's 85th birthday, just open it. $500 will open the contract. So now you have this contract open, the client's 84 and 364 days old. 10 years later, they're 94, they sell their house for $1 million. You could take that million, drop it into the contract that you had opened way back when, and that $1 million will have that 100% death benefit. So that's a very, very cool thing to look at. When we're dealing in segregated funds, for me, it's largely about estate planning, non-registered positions, where we're going to take advantage of insurance-based contracts to name beneficiaries, void probate, creditor protection, all those things that are a little more important on the non-registered side. Also on the SSQ segregated fund side, there is a private wealth management platform. So $500,000 will get you in. That is family. So not household, not individual, not spouses. You can have a brother in Vancouver, a sister in Montreal, doesn't matter. They can all be counted towards that $500,000 threshold. And then we start to discount the management fees. Also, insurance-based contracts, there will have clients out there that do have GICs. You may get more than you'd probably like because of market volatility. We do not necessarily want to be in a position where we're shoehorning clients to take equity risk or market risk when their brains are not suited for it. Maybe we work on them over time, right? I'm not a great lover of GICs, but they have their place, and there's certainly trillions of dollars sitting in GICs right now. So remember, insurance-based contracts offer big advantages. The rates that we're running right now are 4.35 on an 18-month non-redeemable GIC. So not too shabby, considering you get all of the benefits of an insurance-based contract. If you want to go further out, we can do that. Actually, we can go right to 10 years, but these are the max GIC rates to 5. Everything we're talking about today, if you reach out to myself or one of my colleagues on the investment side, we will figure out what best product bucket to use. And we can work together to make sure, again, that the client's best foot forward is being placed. Also, equity index GICs. We're looking, this is a hybrid between an investment and GIC. It is a very unique niche position when I deploy this in clients' portfolios. Clients should not be looking for liquidity, for example. But if we take a look at the top box there, that same low volatility Canadian equity position, the 10 years term, a 90% maturity guarantee, you're looking at 86 cents of every dollar will be put into that investment account, and the balance gets put into a GIC that pays 3.7%. So it's kind of like an equity balance fund with a 90% maturity guarantee over 10 years, and you own 86 cents of every dollar in an equity position. So that can't really be matched in the segregated fund universe. So the trade-off is seg funds have daily liquidity. You can get them anytime. Here, I prefer, they are redeemable, but I would want you to position them as non-redeemable positions, or a gun to your head, you can get the money, but you don't really want to be redeeming these before the term's up. But they have a very special place that we can use them for specific clients looking to achieve certain results. We don't cap the upside on these. I know some of our competitors do. We don't. So whatever that equity index position whatever the investment account does, you're going to get 86% of that. And then the balance obviously is in that fixed rate. Annuities, we have them. We do get, we're very, very, very competitive on rates. We don't post on Canex though. So if you have an annuity client, you want me to run a quote, just let me know and we can do that. And we usually end up on top when it comes to the monthly payouts. They're not huge differences, to be fair, but again, we can do it, and you can do it through the beneva contract. And again, everything you do with us is all eventually going to be housed in one spot. Everything is an insurance-based contract. So to remind everybody, again, more non-registered, but we're talking about getting rid of probate fees, creating that side door for estates where you've named the beneficiaries, they're at the side door, right? If you go through the front door, through the estate door, well, that's where the probate fees, the legal fees, accounting fees, executor fees, that's where the whole world can see what's in your will because they're not private. There's no creditor protection or anything else, right? So we just create everything now. GIC, segregated funds, investment accounts, they're all insurance-based contracts, and we can make sure that the estates settle the way you want them to. So we've got 4 legs of the stool, and risk-free positions, GICs and annuities, segregated funds for everybody who's looking for a maturity guarantee. And then the big deal for us is going to be the La Capitale investment accounts, now known as the beneva investment accounts. This is about RSP season. So unless you tell me different, and the client really, really cares about a maturity guarantee, or you do, if the assets are registered, RSPs, RIFs, LIRAs, LIFs, TFSAs, my default position is going to be into the beneva investment accounts. So I'll just walk you through those. This is the best game in town for registered assets. I don't think there is nothing really comparable on the market. There's one of our competitors pretty close, but it's not exactly the same. And I think we've got a couple of different edges on them. But these are investment accounts for registered plans. They're not mutual funds. They're not segregated funds. They are like both. They share a lot of the same DNA as both solutions. They are sold through your life license, sold through IDC as your MGA, but they effectively replace mutual funds for registered plans. They are mutual funds. We pick up the fund and then drop it, wrap it in this insurance blanket. That insurance blanket allows you to sell it with your insurance license. It has an insurance component in that it comes with 100% death benefit. So the key here, though, it's the same fund and same MER. We don't charge anything over and above what the A-class retail mutual fund would charge. So whatever that is, that's what we charge. So you're effectively getting mutual fund manager, performance, holdings, everything's identical, but we have a death benefit and they don't. So same performance, everything's the same. So it's a really, really big deal because for every dollar in a segregated fund, there's 10 in a mutual fund. A lot of that money is sitting in registered plans. So anybody who owns A-class mutual funds in a registered plan, all of it should be at beneva La Capitale through these investment account platform. Again, because we have a death benefit and they don't, and you don't even pay for it. If you have a death benefit, you're an insurance-based contract, you sound a lot like segregated funds, and there are a lot of similarities. So how the estate settles the same, the potential creditor protection levels are the same. They're both covered by Assurance, that's the same. The big difference comes that segregated funds have to have a maturity guarantee. So when you have maturity guarantees, you have to start adding in additional insurance costs. So every segregated fund, including high net worth pricing ones from some of my competitors, are still going to be more expensive than the La Capitale or beneva investment accounts. So it really comes down to how much do you or the client care about a maturity guarantee? In my humble opinion, I don't at all for registered plans, particularly LIRAs and RSPs. Because if you have an RSP, I shouldn't say be that definitive, but in the vast majority of cases, you have an RSP, the RSP is going to become a RIF. You're paying for a maturity guarantee 15 years out, we'll say, on this RSP. The RSP gets converted to a RIF. The RIF starts to take money out of it. The money, as it comes out of a segregated fund, the amount that's guaranteed at maturity is actually decreasing. So where the market has moved, and I'm sure a lot of people on the call are kind of using these things, and it does make some sense, is that they're using 75 watered down maturity guarantees. Now, I use the term watered down because they're doing it on purpose, right? They want to get, every time you add more insurance, it's going to cost more. Well, we don't even want that insurance, but I'm life licensed and I like segregated funds. I like how they operate. I like doing business through IDC for whatever reason. So they're using these 75s. They have the MERs aren't that bad, right? But the guarantees would be 75% at age 100, 105, 106. That's what the carriers are doing. And it makes sense because they want to get the MERs down to something that looks like a mutual fund. Obviously, we don't have that problem. I'm the same price as a mutual fund right now. But now you're talking about guaranteeing an RSP that converts to a RIF, maturity date of 105, we'll say. What's a RIF worth at age 105? Nothing. So the maturity guarantee is actually useless. So, but the problem is you pay as those fees are based on current market values. So you're paying today for a guarantee that will not be at play when the contract actually comes to maturity. So if you have any contracts like that, we move a lot of them because it's like, listen, you're getting rid of a maturity guarantee you don't even really need or want. It's kind of useless. And it's a 75% death benefit. Every penny we get in the door before the client turns 75 is going to reset the death benefit at 100% for us. Yes, we don't have a maturity guarantee. That's true. So that is gone. But now we've upped the death benefit, which my experience, most of the brokers I talk to, that's the one that they would, that they want to keep. Maturity guarantees at age 105, like I said, don't have a lot of utility. Death benefits, who knows, right? May come in and may not come in. I'd rather have one than not have one, especially with Beneva's investment accounts. I'm not even paying for it. That's all great. Totally different. Lots of value add over what mutual funds being sold at the bank or mutual funds through a mutual fund company. So lots of great things to like. Where the real quality comes in is you got a death benefit. It's free. That's awesome. I don't want it if the underlying investments are terrible, right? So the real magic happens if you can partner that structure with really high quality managers. Now we're really cooking. So companies like Fidelity and TD, AGF, Dynamic, CI, and Fiera, we don't have every investment from these folks, but we've got 42 different investment accounts that we can put together and again create those portfolios, and no shortage of 4- and 5-star funds. And like I said, I have no problem building rock solid portfolios for pretty much everybody. Not gamblers, I use that line. Not good for commodity bulls. People want oil, heavy oil. On pure oil plays, pure gold plays, commodity plays, those sorts of things. Bitcoin, pot stocks. That's not us. These again are going to be mutual funds or diversified and professionally managed, but whether they're conservative, heavy fixed income, more of a balance, Canadian equities, American equities, international equities, or again, we do have portfolio solutions for those who do not want to be involved in picking and choosing funds. I want to hand the keys to AJF or Dynamic. You got a questionnaire, the client's balanced. We bought the profiles from either or both companies, and then we just kind of work on the practice of holistic financial planning. Nothing to do with picking and choosing investments. I'm just going to make sure I do a really, really good job in covering off all the bases: estate planning, insurance planning, basic financial planning, making sure the clients have enough. And I think if you do that for clients, that's really where I think the value does shine. But if you do want to build your own, if that's something, or I actually use both portfolios mixed in with individual positions. So needless to say, we can build the suit. It's not a problem. We're going to be building this unique, totally different product, hybrid, not a fund, not a seg fund, same cost as a mutual fund, but has that 100% death benefit. Anything put in before the age of 75. Estate planning is the same between investment accounts and my segregated funds through SSQ. There is no maximum age. You can actually contribute. Well, I guess it is age 100. You can contribute right up to age 100. But again, you have to get the money in the door before the client turns 75 to qualify for the death benefit. Just so we're clear, the death benefit doesn't go away at 75. It's just the contributions. That's what moves the death benefit up. If you put money in at age 80, say in a TFSA, your death benefit wouldn't have moved from wherever it was in the past. Registered plans, RSP season's coming up. This is, in my opinion, the best thing since sliced bread for life license advisors, because now we can go head to head against any mutual fund, any bank fund, and offer more because we have a death benefit and they don't. TFSAs, RIFs, LIFs, LIRs, LRSPs are locked in RSPs in outside of Ontario and federally, and and a couple other Western provinces. We don't manage the money ourselves. So that's another objection you might get. Who is Beneva? Well, it's a brand new company. No one really knows. Very few people, to be honest, knew La Capitale or SSQ. Don't worry about that part. The combination of these companies now puts us as the 6th largest insurer in Canada and the largest mutual. We were the largest before, but now obviously the SSQ and La Capitale were both mutuals. You add them together and we're the largest mutual. Important, in my opinion, which means we're owned by our members. We don't trade on the stock market. We don't have shareholders to answer to. We have to do what's in the best interest of the client. The fiduciary responsibility is to that client. Clients and shareholders are very, very different people, right? Big publicly traded companies might have to answer to the Norwegian Sovereign Wealth Fund. We do not, right? We have to answer to what's in the best interest of the members, and anybody who buys anything through Beneva now, GICs, life insurance, whatever the case is actually a member. And again, it's sold through your life license. I got a lot of people that are dually licensed, MFDA and life. They start to get their arms around these investment accounts. They look at their practice and they go, I use segregated funds for non-registered for the estate planning and creditor protection, all that sort of stuff. Well, that's my life license. All my registered assets, which usually make up about 70 to 80% of most brokers I speak to, their blocks of business. It's like, I can replace all the funds and I can put them in these funds. They're as good as better or better than what I'm currently using. I'm not layering on an extra cost. And now everybody that I'm moving over is getting 100% death benefit. So it's a very, very big deal. Now, the death benefit, just to kind of highlight it for people, we're not in the habit of paying them, right? Like, we want these things to make money. So over the longer period of time, we're not paying out tons of death benefits, but you may have an individual person where this kind of comes into play. So just to say, as an example, someone put $10,000. This is the Global Monthly Income Fund. That's the reference fund from Fidelity. We call it Global Diversified Income Fidelity. It's the same fund, same MER. So this is the same mountain chart. 10 grand in on January 1st. This was done last week, but effectively it's down about 9% or so year to date. Not terrible, believe it or not. And it's worth $9,175 if my eyes are still working. So if you bought the fund, mutual fund, back in January, and you died last week, your beneficiaries would have received $9,000 and change. If you bought the exact same version of the fund, but did it through you, your life license, your contract with IDC, the beneficiaries would have received $10,000. So it's kind of a layup. Why would I want the mutual fund if I can get the insured version of the exact same thing? So there's a lot to like here. Where I think we can be most effective with you, again, is going through individual client situations, trying to figure out what makes sense. It may be a maturity guarantee. It may be equity index, GICs, annuities, who knows, right? But we'll be able to figure that out. We are very good at running hypothetical comparison. So if you send me a statement and say, this is what the client owns, this is what can you do? Like, how can we build something that stacks up? So remember, I told you I tend to use a lot of profiles or portfolios. This is a standard position for me. So you have the growth profile from Dynamic for 50%. Canoe is actually Fiera. So Fiera Global Equity for 25, Global Equity from AGF for 15, and a Canadian dividend position from Fidelity for 10. Okay. So I don't cheat. We try to line up the volatility numbers so that they're within spitting distance. So in this case here, technically, we're actually less than the client's current portfolio. And the end result is the performance is stronger. So this client we moved over, we established 100% death benefit with us. We moved them from their current position. It wasn't bad or anything like that, but you own these current funds. This is what we can do. On a historical basis, the new portfolio through Beneva is actually a little less volatile, about the same. We can say that. And the historical returns have been stronger for us. And again, the client moves over because now they have a death benefit. Now they can say, I know at minimum my spouse is going to get this. Right? Whatever we get in the door, that is the death benefit. Right? So if you take advantage of myself and my colleagues, reach out to us, give us, just send us the statements. In most cases, we can run these hypothetical direct comparisons. We can't do it against pooled funds. So we do get some pension positions as well as group RSPs. Typically, those don't report anywhere, so it's kind of tough. But we can still look at it and go, okay, this is what the client currently owns in terms of asset allocation breakdowns, in terms of lots of different metrics. We can figure that out and say, this is what we'd be looking to do on our end. So RSP season's coming up. There's going to be some changes in terms of the beneva contracting. There's going to be some new applications and things like that. We'll make sure that everybody has access to all of the new paperwork and all that sort of stuff. So like I said, we are starting to get into more of the overt phase of the actual merger. Keep your eyes and ears open for that stuff. We do run a bi-weekly wealth webinar where we cover off a lot of different things from portfolio managers, administrative tips, sales practices. I would imagine the next couple will probably focus on the migration into beneva and the platforms and things like that consolidating. There is one major thing that I can share with you. In the past, we'll call them the La Capitale investment accounts never counted towards loyalty bonus at La Capitale. They're so cheap that they didn't want to add them in to have extra compensation paid out through the loyalty bonus program that they were running. SSQ had something called the merit bonus program. The La Capitale investment accounts were never included in those either. They are now. Starting in January, sales within the investment account platform will count towards the new beneva merit program. So take a really good situation and then add the ability to earn a little extra compensation. What we're really trying to achieve here is beneva is a play in technology, it's a play in branding, and it's a play to be kind of like a major position within the MGA network insurance brokerage community. So you've got all these great insurance products, very strong UL policies, term, all critical illness, disability. We have all of those things covered. And now on the investment side, you have investment accounts, which no one else really has. You've got segregated fund platform for those segregated fund type clients. You've got GICs, you've got annuities, and you have equity index GICs kind of all in under one house. And that house is, the bricks are starting to go up a little bit more than have been in the past. So yeah, we're here to help. Graham, that ends the formal part of it. If there's any questions, I'll be happy to answer them. And I'll try to get a copy of this presentation as well as the piece from David Fingold and other bits and pieces that might be relevant. I'll try to get those sent out.
It's always informative. And I think we did, you hit the nail on the head as far as the toolkit. Some of the stats and the figures in there are obviously very, very applicable to the situation we've gone through in the last year, and a real demonstration as to why we should be looking at active money. A couple of questions here. I think something we can take them offline. I can give you the advisors to speak to directly. It's probably more applicable for that. A couple of things that I had actually picked up I thought was really quite nice. You mentioned David Fingold. I was fortunate to have a dinner with him in the last few weeks, and it was an incredible experience. And I'm not one for typically promoting individual managers, and I like the fact to fund of funds and manage money and reducing risk that way. But Dave is just such an engaging individual, an engaging manager, somebody that's at the top of his game, in my personal opinion, as far as what he does. And he'd mentioned something when he was talking about how he's compensated, which I think is important to share. He gets the majority of his bonus each year in units of his own funds. He owns no other outside investments other than the money that he actually manages. So that's a very powerful statement when it comes down to if you truly believe what the manager's done, he's doing the same thing himself. So a lot of people don't follow the same mindset. So Dave is definitely, I think that's a gem on the platform. I really do. I just think that's fantastic. Householding, this comes up frequently from advisors about different householding policies as far as put money together and lowering MERs. It's a typical argument as to how do we get money from the bank? It's so cheap at the bank. How do we move the money over? So if we're looking at consolidation, just that householding that you mentioned, I think is something very, very, very key that people should keep in mind and lowering the overall amount. The equity index GIC product. I mean, I don't think there's a day going by right now that I'm not getting asked about GICs. All of a sudden it's become the thing again, right? So another reason why people should be speaking with you, quite frankly, I don't think that's something we can hide away from. We want to talk. A question I get frequently is, who should I put my money with? So that comes up all the time. And if we're talking about RSP portfolios, what you've demonstrated today with the investment accounts, I think that is definitely something that should be top of list. If we're looking at, we're looking at the death benefit. To me, what we are selling is an insurance product. I think a lot of people don't quite get that. Like, we have this habit of putting everything in the investment world together. So seg fund is now an investment product. It's getting compared to low cost indexes and stuff like that. That's not the case at all. This is an insurance product. To me, the insurance product means it has a death benefit. And in this case, we're offering something that's of a massive, massive value add, and there's no real cost over and above what a typical mutual fund would be. So for those people on the line, that's something I think that, again, that should resonate as an opportunity as we go into 2023. The last thing, you touched on loyalty bonus. I'm a big believer in getting paid for what we do. I don't think we should shy away from these kind of things. So if we're looking at increasing revenue inside our respective businesses, well, something, there's an extra revenue source that people can generate for the right reasons. We've got a low cost solution that's perfect for the RSP season. And it's going to pay you more or lead you to getting more revenue coming in the door by the end of the year. I think that's a fantastic story, and I don't think it's something we should shy away from or not talk about, or get it right out there in the open. And then finally, the last point that stuck out to me was that optimal deposit at age 85. Like that, having that 100% death benefit, that's huge. We know the demographics. We know the aging that's going on right now. People are not getting any younger. There's a massive amount of money that's waiting to transition, and it's going to happen. So I would recommend to everybody on the line that you have not done that client segmentation, you've not, or maybe you have and you've not specifically looked at that much older client, because there's nothing really we think we can do with that client. Well, there is, quite frankly, here. Let's get that account opened up for potential use going down the line. Use that as the excuse to open up the conversation with the client's children. Why are we doing this? People are having conversations about what's included in the will, what's the role of the executor, et cetera, et cetera. This is the kind of stuff that can help ease the burden on a family, and as we know, get the money to beneficiaries quicker and easier inside the insurance environment. So I think that's there's 5 things right now that I've taken away from a packed presentation, and it's a little bit more than just an RSP discussion. When we're talking about that older client, we're talking about large money transfers. We're talking about getting more clients to the table, or the prospects to the table that are going to inherit this money. We don't want that money going anywhere else. We want that money staying in the family. You as an advisor want to make sure that work you've done with that older client all these years stays with you. So I think that's really, really important. And Andrew, as usual, I used that word experience earlier on. I think that's what experience shows, when you can present like that and give information that people can actually use, and it'll make a difference in their books of business. So thank you.
Anytime, like I said, reach out. There's lots of good things here. So yeah. Yep.
And obviously, your contact information went up at the video. I think it was the first slide there, but anybody on the line that needs to speak, you didn't quite catch those details, obviously reach out to me. Everybody knows my email contacts and so on, and I will make sure that the introductions are done and the right people are passed to the right people. So I think with that, we're almost bang on time. And as I said, I encourage everybody in the line to bother Andrew. He loves having conversations with people.
I do.
Doesn't sleep. Doesn't want to take holidays. Doesn't want to play golf in the summer. Just inundate him with business. He's going to love it. So thank you once again, and have a great holiday season to yourself and to everybody on the line.
Likewise. Merry Christmas. Happy holidays, everybody. Stay safe. Have fun.
Perfect. So we'll shut it down there. Thank you.